Okay, so this problem is very similar to the last one, except for the last one where we sold a piece of equipment, the equipment was sold at the end of the year. Notice that this one, it's the same exact evaporator. It still has a zero salvage value, and they're still using a straight line method depreciation. But this one, instead of being sold at December 31st, is now being sold at June 30th. And so whenever you have an asset that is sold during the middle of a year, the very first thing you have to do is catch up the depreciation. You have to record the depreciation since the last time it had been recorded. Because typically, if you have a company that is that is producing annual financial statements, the last time depreciation would have been recorded would have been December 31st, 2015. And since you're not selling this till June 30th of the next year, you'd have to record depreciation for January 1 to June 30th of 2016 before you can do any of these other calculations, the book value at the time of sale or the gain or loss on the sale. And so let me bring up my example so we can walk through this. So I'm going to use the same exact piece of equipment that we used in the last video. And we purchased this asset on January 2nd, 2011 for $35,000 cash. We have an 8-year useful life and a $1,500 salvage value. And we're using the straight line method. But instead of being sold at December 31st, 2016, now you'll notice that this piece of equipment is being sold on May 31st, 2016. Okay, so the last time the depreciation was recorded was on December 31st, 2015. So we recorded the whole year's worth of depreciation at December 31st, 2015. And so I've got the straight line depreciation calculation over here again, cost minus salvage value divided by useful life. The cost was $35,000. The salvage value was $1,500 and the useful life was 8 years. And when you plug that into the calculator, you come up with $4,187.50 per year. And so for 2011, 2012, 2013, 2014, 2015, that would be the amount of depreciation that you would have recorded every year. And so that's 5 years worth, right? January 1, 2011 through December 31st, 2015 is 5 years worth. But now we've owned it for an additional, 5 months, January, February, March, April, and May. We're at the end of May, so we depreciate it for the whole month of May. So we now also have depreciated for 5 months more. And so my cost is still $35,000. And my depreciation for each year that I did is still $4,187.50. So I can still take that $4,187.50, multiply it times 5 years, because I would have debited depreciation expense and credited accumulated depreciation for each of those 5 years. So my depreciation at the end of December 31st, 2015 would have been $20,937.50. However, I owned it for 5 more months, so I need to figure out what my depreciation is per month and then multiply that times 5 months. So I'm going to do that calculation over here. So now I'm going to take the $4,187.50 and divide it by 12 months, because that's how many months there are in a year, to come up with my monthly depreciation of $348.96. Okay, so how much more depreciation do I have to record for those 5 months that I owned it, January 1 through May 31st? I can take the $348.96, multiply it times the 5 months that I owned it, and that gives me an additional $1,744.79. So before I do anything to record the sale, the very first thing I have to do is catch up that depreciation, record the depreciation expense for those 5 months that I owned it in 2016. So anytime you're reporting depreciation, you're always going to be debiting depreciation expense and crediting accumulated depreciation. So the debit to depreciation expense and the credit to accumulated depreciation for the year of 2015 would have been done December 31st, 2015. Now what I'm doing is I'm recording the monthly depreciation for these additional 5 months that I owned it. So $1,744.79. And you don't have to do this in my open math. I'm just going through the calculations for you, because you may have to do it on a quiz or a test. Okay, so this is to record the partial year depreciation for January 1 to May 31st. And so to figure out the book value at the time of the sale at May 31st, you have your cost minus the 5 years of depreciation to January 2011 to December 31st, 2015 of $20,937.50. And then you also have to subtract out the 5 months of depreciation that you just did right here for January 1 to May 31st. And again, you don't have to do this journal entry in MyOpen Math. I'm just showing you for general purposes. And so now to figure out the net book value, you have to take the cost and subtract out all of the depreciation you've taken, the 5 years plus the 5 months, to come up with a net book value of $12,317.71. So this is what MyOpen Math is asking you to record, okay? And so then the next thing it's asking you to do is figure out what is your gain or loss. So the next requirement is to calculate the gain or loss. And remember that if you have a loss, you need to enter that as a negative amount. And so how do we calculate the gain or loss? We take the net book value we just calculated, and we compare that to the sales price. So I have a net book value of $12,317.71, and it told me that I sold it for $13,500 cash. Let me convert these both. There you go. So, do I have a gain or do I have a loss? Well, net book value represents what we thought the asset was worth. So $12,317.71 is what we thought it was worth, but we actually were able to sell it for more. We were able to sell it for $13,500. So whenever your sales price exceeds your net book value, you have a gain. And so I can now take the $13,500 and subtract out the book value to come up with how much that gain was. And so I have a gain of $1,182.29. So this is the next item that you would have to key in to MyOpen Math. And your problem might not be a gain, it might be a loss. You might have a less of a sales price than you have for book value, in which case you would have a loss here. All right, then the next part asks you to record the journal entry at May 31st to record this sale. So again, the very first item that I would always record on the sale of an asset is the cash that you received. And we know that we received $13,500 cash. Cash is an asset. It's increasing. Our bank account is going to be going up. So anytime you want to increase an asset, that has to be debited. The next thing I would always do is I would remove the accumulated depreciation that I have on the books for this asset. Because remember, your cost of your asset and your accumulated depreciation are linked together. Whenever you remove one, you have to remove the other. And since I'm selling this asset, the asset has to be taken off the books and the accumulated depreciation has to be taken off the books. And so accumulated depreciation carries a normal credit balance. And so in order to reduce that or remove it from your books, you have to debit it. But I'm not going to debit it for $20,937.50. I'm going to debit it for both of these added together, because remember, I would have recorded the depreciation for both of these as of May 31st before I would record the sale. So I need to debit accumulated depreciation for the sum of these two together, which if we add those up, $20,937.50 plus 1,744.79 is $22,682.29. Okay, that's just the sum of the 5 years of depreciation and the 5 months of depreciation that we took. And then we have a gain. All right, and we said in the last video, if you had a loss, you always debit the loss on sale of asset account. But if you have a gain, that's always a credit. And so I'm going to indent that because credits are always indented. Gain on sale of fixed asset or gain on sale of equipment, whatever MyOpen Math has there for you. And my gain we calculated was $1,182.29. And then the last thing you have to do is take this piece of equipment off of your books. Could be equipment, it could be machinery, whatever MyOpen Math has. And my cost was $35,000 on that. That cost would have been sitting there the whole time. And the very last thing you should do, again, always, is make sure you have an equal dollar amount of debits and an equal dollar amount of credits. So let's make sure we have that. So if I add my debits, I've got $13,500 of the debits and $22,682.29 worth of debits. And then I also have credits of $1,182.29 and $35,000. So when I look at that, they are equal, so my journal entry is in balance. Okay? So the next thing I have here on the spreadsheet is how would this be different if this asset only sold for $10,000? Instead of selling it for $13,500, I'm only selling it for $10,000 this time. So let me insert some rows there. So now we don't have to do any of these calculations again. The only thing we have to do is recalculate whether I have a gain or a loss with these new parameters. So my net book value is still $10,317.71, but this time I only sold it for $10,000. So since I thought it was worth $12,317.71 and I only was able to sell it for $10,000, then I have a loss. And again, that has to be entered as a negative amount. And so when you record that, again, you have to record the cash. This time I only received $10,000. Cash is increasing again, so it would be debited again. My accumulated depreciation still has to be taken off the books because now I'm selling that asset. So not only the asset, but also the accumulated depreciation both have to come off the books. And my accumulated depreciation is still $22,682.29. Now I have a loss, and losses on sale of accounts, or I'm sorry, on sale of assets are always debits. So I'm going to record that next because it is a debit, and all my debits always come first. And then I have to remove that piece of equipment, and it was still had a cost of $35,000. And the very last step then is to make sure you have an equal dollar amount of debits and an equal dollar amount of credits. And so when I add these three items together, they do come up to $35,000. You can see here I've highlighted over them, and you can see down here Excel has added them up for me. I've got a sum of $35,000. And so I've got $35,000 of debits, $35,000 of credits, and my journal entry is in balance. Okay, so whether you have a gain or a loss, that's the way your journal entry should look. You're always going to be debiting your cash for the amount of cash you received on the sale. You're always going to be debiting your accumulated depreciation to take that off of the books. You're always going to be crediting the equipment to take that off of the books. And then it's going to depend on whether you have a gain or a loss on the sale of the asset as to whether you're going to debit or credit that account. If you have a gain, you're going to credit that account. If you have a loss, you're going to debit it.